Hi, I'm Patty Healy, Senior Vice President of Research for Cumberland Advisors. I'm filling in for Matt McAleer's Week in Review as he's on vacation with his family. Today is July 5th, shortly after the stock market close. Later in the program, I'm going to be joined by Leo Chen, Ph.D., Quantitative Strategist and Portfolio Manager here at Cumberland Advisors. I work in the Fixed Income Department at Cumberland Advisors and spend most of my time evaluating municipal bonds and things in the marketplace that could affect the credit quality of municipal bonds. Overall, we've seen positive economic growth, and that economic growth is continuing. Even the budgets of major states show continued economic growth. So that leads me into the jobs report. This morning, the jobs report was released with an increase of 244,000. This is up from estimates of 160,000 and up from a revised level of last month of 72,000. So it was a big increase in economic growth, bigger than people expected. Now the marketplace had put into its estimation that the Fed was going to cut rates 3 times this year. Now with this strong economic growth and the Fed being data dependent, the thought is that maybe these rate cuts won't happen as quickly or won't be at the level that they were. So the bond market reacted by yields going up and prices going down. How do we deal with this in our fixed income portfolios? Well, I think last week you may remember that John Musso mentioned that we thought that economic growth was still strong here in the United States, and because we think that interest rates might tend to go up a little bit, we've been shortening our duration. Since the end of 2017, yields have come down tremendously, and especially in the municipal bond market, where there was a dislocation in pricing where some muni bonds were yielding more than treasuries. So since the end of last year till now, we've had some very, very good bond performance and have taken some profits. At this time, Leo Chen is going to come up and talk about the equity markets.
Thank you, Patty. I'm Leo Chen, Portfolio Manager and Quantitative Strategist at Cumberland Advisors. This week, the equity market started with a strong rally after G20 meeting. President Trump and President Xi had a ceasefire meeting. It wasn't the end of the trade war, but the market took it as a positive note. Of course, the equity market has been rallying based off the possibility the Federal Reserve would cut rates this year. The market has priced in 1 rate cut in July and possibly 2 to 3 cuts this year. However, after this morning's stronger than expected jobs report, the market started off with the sell-off, but the equity market has been resilient. They paired the losses, all 3 major indices, paired losses today at the end of the day, and closed at the flat close price. From now, we can see that the market is still pricing in the possibility at least 1 rate cut this quarter. However, we will not know for sure until the end of the month, the FOMC meeting on July 30th and 31st. And before then, we still need to caution our investors that today, including Wednesday, July 3rd, the volume in the equity market has been low. What that means is that we will not know for sure how the market reacts to today's jobs report until probably next week, even probably next Wednesday, after Jay Powell testifies in front of the Congress. With the jobs report, it just adds more uncertainty to the market. Investors will have to wait till the Federal Reserve makes their decision in July. At this all-time high market, it is wise to add some protection. For example, if you're wondering if the market will finally go above 3,000 on the S&P, but you're worried about losing your capital in the meantime, you can add to more defensive positions such as utility, staples. Even financials has been a popular sector since June. Especially with the yields coming back up, financials may not be a bad idea. At Cumberland, we do have a 23% cash holding in our US ETF portfolio. Our quantitative strategy, market volatility, and leverage market volatility are still in cash. We have been in cash in the past few months, waiting for the next entry. In our overall portfolio, we're comfortable with our positions in the sectors and also with our cash holdings. As we're waiting for the Fed signal, we will adjust our positions accordingly.
Okay, well, thank you, Leo.
Thank you, Patty.
Thank you for listening, and as always, we welcome your comments and questions that via email or that we can address in future videos. Thank you.